Hey everyone, welcome back. This is John from Friends with Your Benefits. So I want you to picture this. Let's say you've been working for a company for the past 5 years. You're a really good employee, you work hard, and in return for being a really good employee, the company happens to offer you a halfway decent health insurance plan that you're satisfied with. Now imagine this further. Say it's December and the company sends out a little email saying, hey, that medical insurance plan that you're enrolled in, guess what? Come January, we're not offering you that plan anymore, but we are going to offer you 3 brand new medical plans. How would you feel? I'm sure many of you would feel a little shocked, a little angry, and a little confused, to say the least. So, how would you ultimately go about making a decision for yourself? Well, this actually happened to one of our subscribers recently, and we'll walk you through how we helped him make a decision for his 2022 benefit elections. Make sure you watch until the very end, as this tactic may work for you. In just a moment, we'll bring you over to the big board. So, when I like to evaluate differences in medical costs that I may be responsible for in the future, there's a few things that I like to do. So, number one, I like to line the plans up side by side and really understand the high level differences. So, you see here, there's ultimately 3 plans that our subscriber is going to be offered. There is the 2B plan, which has a $1,500 deductible. There's a 3B, which has a $0 deductible plan, certainly sounds enticing. And then there's a 4B plan, which has a whopping $2,000 deductible. The next thing I like to look at is something called HSA, or Health Savings Account eligibility. We take a look at the first 2 plans, and the first 2 plans are not HSA eligible. The last plan certainly is HSA eligible. If you want additional details on how HSA plans can help you invest and save a lot of money in taxes, feel free to click the link in the upper right-hand corner. In terms of cost per paycheck, so our viewer did provide us that, hey, for the 2B plan, the cost is $306 per paycheck. 3B plan, the $0 deductible plan, is $361 per paycheck. And the 4B, and that's the HSA eligible plan, is $205 per paycheck. Now, our subscriber happens to be paid 24 times a year. So we take the paycheck times 24, and we see for the 2B plan, it's roughly $7,300 is the total amount that will come out of the paycheck over the course of the year. The 3B is going to be a bit more. It's going to be nearly $8,700. And the 4B is going to be a lot less. It's going to be about $4,900 per year. The next thing I like to look at, and this is really important, is something called the out-of-pocket maximum. The out-of-pocket maximum represents the total amount that you may have to pay in medical bills to healthcare providers if you happen to have a really high claims year, or if you know what happens to hit the fan. So for the 2B plan, it has a $3,000 out-of-pocket maximum. For the 3B plan, out-of-pocket maximum is $3,500. For the 4B plan, the out-of-pocket maximum is $6,000. We add up the annual paycheck cost and the out-of-pocket maximum, and we see for the 2B plan, it's about $10,300 per year. The 3B plan, remember, this was the plan that had the $0 deductible, is about $12,000 a year, a bit more. And the 4B plan has a total exposure of about $10,900. So again, this is the worst case scenario. Now let's just take a look at this. If we look at the 3B plan and we compare the $12,200 to the $10,300, we see it's a difference of about $1,800. So right off the bat, the 3B plan should probably be eliminated, because if we happen to have a really high claims year, even though the plan on paper may look better, we're going to overpay for this plan. So this one we should definitely throw out, and we'll just immediately delete this one. In terms of the 4B plan, we see that, hey, if we happen to have a high claims year, we could potentially be worse off by $567. So that's not the end of the story, though. The other way to look at it is what happens if we actually have no claims? What's the quote unquote best case scenario? The best case scenario is you'd actually save about $2,400 per year. So you have a big swing here. You could potentially incur additional cost of nearly $600 per year or have a potential savings of $2,400. That's a swing of about $3,000. So John, how do we ultimately pick? Really what it comes down to is a judgment call. If you're someone who's really risk adverse and you're not comfortable potentially being worse off by $600, you may want to take the 2B $1,500 deductible plan. On the flip side, you may see that, hey, there's a savings of about $2,400 if I have no claims next year. And while I'll probably have some healthcare claims, certainly this plan could lead me in the black. So maybe I should consider it. What I like to do ultimately is hedge my risk. So what I potentially would do would take some of that differential of that $2,400 and put it in a health savings account to allow me to pre-fund for any deductible expense that I have. That way, I know that if I happen to have a tougher than expected claims year, I have money in the health savings account. I'm sure many of you are wondering what our subscriber ultimately picked. Well, our subscriber took a look at the options and decided that the 4B HSA eligible plan was right for him and his family, so that's the option he's going with next year. We'd love to hear from you on if you have any similar situations. Feel free to comment below. As always, we encourage that you like the video, subscribe, hit the bell, and until next time, thanks for joining.